Hey, good morning. I'm going to call to order the Kentucky Retirement Systems Board of Trustees quarterly board meeting for June 16th, and we're going to begin with a legal public statement.
Yes, sir. This is a quarterly meeting of the Kentucky Retirement Systems Board of Trustees. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statutes, Section 61.826, and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. Please ensure that you are on camera when making or seconding a motion or casting a vote. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. Roll call and public comment, please.
Yes, sir. Mr. Piercy?
Here.
Ms. Bova? Ms. Eves? Ms. Hampton?
Here.
Mr. Lane?
Here.
Mr. Raleigh?
Here.
Mr. Summers? Ms. Thompson?
Here.
And Mr. Totten?
Here.
Thank you. As far as public comment, we have not received any public comment for today's meeting.
I was just going to say, Mary is here. I don't know. I think she was muted when she spoke, but she's with us.
I am here. Mary Eves is here.
Okay,
Sorry.
thank you. No problem. I'll mark her attendance.
Okay, that takes care of roll call and public comment. Our next item is the approval of minutes from the April 16th meeting, and I'll seek a motion.
So moved.
I second.
Okay, any discussion? Seeing none, all those in favor?
Aye.
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 Any opposed? And that motion is adopted. And our next item up is the Joint Retiree Health Plan, and Connie is with us.
Thank you, Mr. Piercy. The committee met on Wednesday, May the 13th, and elected Keith Piercy as chair for this year and Dr. Patricia Carver as vice chair. Humana went over several statistical informational notices from last year, and then at the end we do have one vote. So first I wanted to go over with Humana some of the information they gave us. For 2025, it's noted that not only did the pharmacy benefit increase in claims payment as far as utilization and payment, so did the medical for this plan year, and some of it is still running out, although it's pretty much it's June now, so you can see in that second paragraph there the statistics, and they are getting pretty high for the pharmacy costs. Note that the committee looked at more detailed information along utilization and cost measures. With this, we also looked at member participation in the health alerts, preventive screenings, engagement, silver sneakers, etc. Those all remain positive or flat, and wanted to let you know that the performance guarantees and the gain share, those things are being met. Performance guarantee by reporting quarterly that comes to me from Humana, and so looking at that, go ahead. Sorry. No, go ahead. You had a question, maybe, about the Humana reporting around the quarterly performance guarantees. It's around the call center stats and how fast the claims are paid, different things like that. There's several pages of measures the committee and the business users look at each year to see how Humana is performing on that. And if they don't perform, of course, there's money tied to that. I think we've mentioned that to you all in the past. But know that they looked at the projection for next year, the Medicare final notice. We don't have the renewal yet. That'll be towards the end of June, maybe the first week or so of July. But they're looking at an average of 2.48% increase. So that's what Humana is looking at right now to see, how that's going to impact any cost in 2027. Now, I'm going to let them talk about how the Inflation Reduction Act and how it is still impacting for years 2023 through 2026, because you're going to see, and as well, the change that has happened in retiree behavior in regards to the maximum out of pocket for going down to $2,000 versus the $8,000 a year. So, Joe or Carrie or
Yeah.
someone in Humana.
Hey, Connie, Joe Coles. I'll
Hi.
get it kicked off, and then certainly Stephanie or Carrie, if you guys want to jump in. Can everybody hear me okay?
Yes, we can.
Yeah.
Perfect. So the Inflation Reduction Act was put in play, I believe, in 2023, did a lot of things, but as it relates to Medicare Advantage, the key is the maximum out of pocket was moved to $2,100. And so most of our group plans and individual plans for that matter had a maximum out of pocket of around $8,000. And so this was a legislative change that the MOOP went from 8,000 to 2,000. So the result of that is a material member benefit that enhanced the benefits significantly. And so what that means from a maximum out of pocket standpoint is that, and there's a lot of math underneath that, but we'll keep it high level, is that once a member met that maximum out of pocket, it was 8,000, then it became 2,100. There was no member cost share. So they did that from a policy standpoint, really to impact the individual Medicare world, where benefits, particularly pharmacy benefits, aren't as rich. For group plans like KPPA and in other large states, the group benefits are pretty rich. They're good benefits. In the individual space, they're less so. So what happened is when the MOOP went reduced from 8,000 to 2,000, what we saw in 2025 utilization is basically the member cost went down on average between 15 and 25%, but the plan cost went up a commensurate 15 to 25%. And that's a PMPM. So what we saw is it was a great benefit to members. And I believe Connie shared in our meeting a couple of weeks ago that she actually got some calls from KPPA members saying, hey, it's great. It's only February and I don't really owe any more dollars on my pharmacy copays or cost past February because they had actually met that $2,100 move. The issue is it puts more pressure on the plan because costs, again, have gone up from a plan cost PMPM that 15 to 25%. And so it's millions and millions of dollars. And so while it's a great thing that the member received an enhanced benefit, when we talk to our customers, we say, your board did not vote on that change. That was a federal change, a law change that CMS put into play. So it's a great benefit to members, but it does put some cost pressure on the plan. And so, Connie, I mean, you saw that in our numbers. I'm not exactly sure exactly what the KPPA numbers are because I don't have them in front of me, but on average is around 15 to 25% increase on plan cost, but a commensurate reduction in member cost.
And I think you're going to take the committee charged the Humana with taking this phase in of this, how this is working with statistics of utilization costs, and bring us additional reporting around this as it rolls out into 2026. And then we might want to look at it again later in the year, even the beginning of next year, to see if the committees want to look at any of these potential benefits to consider that they did look at there. So I feel like, Humana, there's more to come. There's more to discuss around this. And then the renewal is certainly going to give us some information to look at in the September committee as well as board meetings. Is there any questions around this for Humana or myself around this part of the memo?
Connie, this
Yes,
is Mary
ma'am.
Eve. Connie
Yes.
and Joe, I know private employers, everybody's been experiencing increases in pharmacy expenditures. And I know private employers have been dealing so much around what can we do about specialty drugs, because that's their main focus of the increase, the cost of specialty drugs. Is that a significant problem or significant issue in our increase, or is it more the other things that Joe mentioned, the decrease in the maximum out of pocket and just general pharmacy use.
I'm going to say both, but I want Joe
Yeah, I
to kind
agree.
of.
No, you're
Okay.
100% right, Tony. The specialty drug pipeline is very robust right now as, the pharmacy manufacturers, you guys can watch the local news, right? And every night at 6 o'clock, I mean, and I've actually counted these before. I think I saw 6 or 7, drug commercials in a row to address, high cost conditions. And so clearly, as you pointed out, those expensive drugs, if a member's on those expensive drugs and with the reduction of the MOOP, they're going to go ahead and get there quicker. If they were simply on a generic drug that was $10, you can see they wouldn't reach that $2,000. So I think one thing I did want to point out, Connie, in this paragraph is you guys saw that there was a reduction in the total cost. It says, the average member out of pocket was reduced from $950 in 2024 to $470. So just you can see again all the numbers point. But yes, there's a robust specialty drug pipeline, and when you combine that with, and so yes, we are seeing an uptick in specialty drug use, and then when you combine that with the MOOP, you can see how the costs can grow pretty quickly.
What is Humana doing about that? I mean, what are your
Yeah, so we have some formulary management that takes place. Biosimilars are coming to the market, which are really what you would call something similar to the concept of generics for specialty drugs. So I can tell you that I know we're making some formula changes in the formulary to bring biosimilars to the market and add those to our formulary that will hopefully bring down costs in the next couple of years. Also, you're aware of the CMS price negotiations, which they select 10 expensive drugs. And so we're hoping, and that's a CMS project, that hopefully those are addressing some of the most expensive and highly utilized specialty drugs in oncology and other, specialty conditions like that. So we're doing everything we can, trust me. And it's a great question because specialty drugs is a real problem. But I think, from formulary management, as well as some things that CMS are doing, we're trying to do the best we can to manage those trends.
Do you have any other questions?
Like none, Connie. You
Okay.
got, you want to go ahead and
just
continue?
yes, sir. The last thing we're going to talk about is the Kentucky Group Health Insurance Board, which was created by a statute with the state. It's 18A, and it's the goal to provide quality health care, affordable health care, so the Commonwealth can retain and dedicated public employees, and to facilitate the need for comprehensive, effective planning, implementation, administration of the state employee health insurance plan. And in that provision, there is a recommendation for a retiree. And we have a volunteer. The committee looked at Mr. Larry Totten has agreed to do this, and we need you to ratify this recommendation, and therefore we can put him on that board with me as proxy. I have been proxy since probably 2011 or before. Just right now, we currently still have Jerry Powell on the board as a retiree with me as his proxy attending the meetings. And Mr. Totten has been there in the public as well. I just want to mention his participation has been there as well. Thank you.
So I will seek a motion to approve Mr. Totten to join the Kentucky Group Health Insurance Board.
So moved.
I second.
All right. Any discussion? Seeing none, all those in favor?
Aye.
Aye.
Thank you all.
Aye.
Any opposed?
Aye.
And that motion is adopted. Connie, I think that's it for you, correct?
Yes, sir.
Okay.
Mr. Piercy, sorry. Ms. Eves, you are not on camera, and so the statutes require you to be on camera to second or make a vote.
Okay, I'm trying to turn my camera on. Still not on?
I cannot see you. I see a big M. I don't know about anyone else.
It came on. There you go.
There you go.
There you go.
Okay, thank you. Sorry.
You just want to make it clear, Mary, you were voting aye?
I vote aye.
Okay. Thank you.
Thank you, sir.
And Keith, I'd like you to report as abstaining.
Okay. All right. So Larry is abstaining from the vote so as not to appear biased in favor of himself.
Yeah, I usually vote for myself, but I'll pass.
Okay. All right. So that motion is adopted. That's it for Connie. Thank you very much. And our next item is the hybrid percentage and KRS allocation with Mike Lamb.
Thank you, Mr. Piercy. This memo is to allocate the approved hybrid percentage that's going to be effective July 1 among the KERS non-hazardous, the KERS hazardous, and the SPRS plans. The KPPA board met on March 19th and approved the fiscal year 27 hybrid percentage. And the hybrid percentage for KRS is 35.62%, and for CERS it's 64.38%, and that will be effective July 1. The reference to last year's hybrid percentage is there, and then as we have done in the past, we allow the individual boards to allocate their percentage to their three, in this case, their three retirement plans. So, and that's been done by membership headcount as of 6/30/2025, and there's the breakdown of that, and then how your percentages will be allocated related to admin expenses starting July 1. And so I seek an motion and an approval for those percentages from this board today.
I'll make the motion to adopt as presented.
I'll second.
Okay, we have a first and a second. Any discussion? Seeing none, all those in favor?
Aye.
Aye. Any opposed? And that motion is adopted. That's it for that topic with Mr. Lamb, but he stays with us to do the draft administrative budget.
Yes, so this is the draft fiscal year 2027 KPP administrative budget. It will be presented to the KPPA board on 6/25 seeking approval. We had a budget ad hoc committee that submitted the biennium budget request through the normal legislative process back in October. Then when the legislative session met, they went through all agencies' administrative budgets, and we were given through House Bill 500 our allocation, which is $49.8 million. So there's a couple things I want to walk you through here. Our biennium budget request that we submitted back in October was probably about $1 million less than we anticipated we needed. We were restricted based on some baseline numbers, our current head count, our current salaries, etc. So that's why we didn't ask for what we thought we needed, because we were kind of constricted. And then House Bill 500 actually provided us another $1 million less than what we asked for. So we were about $2 million short from our best guess of what we would need for fiscal year 27. So that put us in a little bit of a pickle. And so I've broken that out there. So the first column is what our budget was for fiscal year 26. That yellow is what we think we're going to come in at the end of June, at the end of this month, which is about 500 less than what we were budgeted. And then we requested $50.8 million in the biennium budget request, and that was approved by the KPPA board back in October. And then House Bill 500 gave us $49.8 million. And so our proposed KPPA budget, currently the way I calculate it with the executives and all of the divisions within KPPA, it looks like we need about $51.2 million, and that leaves us short by about $1.4 million in this particular allocation. So we've reduced some items, and then we've looked at our personnel costs, and we're going to continue to manage those as management. We have about a 4 to 5% amount that we need to manage as executives during the fiscal year. So basically, we can't ask for more than 49.8 million because that's what the House Bill 500 gave us. And that's what we're going to present to the KPPA board for approval is 49.8 million. And I'm just showing you these numbers to kind of show where I have to reduce some of that stuff. So on the next page, that current 1.4 million that I'm short is going to come out of salaries by about 945,000, and then there's some residuals that come out of, if you reduce salaries, your FICA goes down, your retirement contributions go down, and that accounts for that 1.4 million. And I was just showing some other areas of budget to actual from 26 to 27 in these 2 pages. So it's really just for informational purposes, and to give you guys get a little bit of a background of where we came up with 49.8 million, why that's a little bit different than what we asked for in the biennium budget request, and then how we're going to manage that as executives within the fiscal year 2027. And so this is just for informational purposes only, and it will go before the KPPA board next week. And so I'm happy to elaborate on anything or answer any questions you have related to the draft budget for 27.
Questions or comments?
Yeah, my question, what about legal? Did you look at legal expenses for potential?
Yeah, so if you look on that page right there, we had 1.8 million budgeted for this fiscal year. We've only spent about $700,000. This was as of 5/31. And so in working with Michael and looking at the cases that may close, or any other things, we reduced that budget to 1.3 million for fiscal year 27. Now, that's Michael's best guess. We're optimistic that maybe some other cases may close and that may be less in the fiscal year, but we also have to leave a little bit of room for things that pop up. But yes, we've reduced the legal budget by about $600,000 from year to year.
Anything else on this topic for Mike? And if not, this was informational only. We will move on to the quarterly financial reports. Mike has that as well.
Yep, so beginning on page 15. So these reports again are as of March 31, so they're a little bit stale at this point. But we can see that the total fiduciary net position for the KRS system is at $10.651 billion. And that's up 14.8% or 1.4 billion from the 9.2 billion prior year March 31 amount. The 3 pension plans total 7.7 billion. The 3 insurance plans total 2.9 billion. In the middle of this same page, we can look at the total investments at fair value. They've increased by 14.52% year to year. And the pension plans are up 19.78%. The insurance plans are up 8.98%. The largest increase in value is with public equities, which is up 21% or 652 million across all of the 6 plans, followed by core fixed income and specialty credit. On the next page is the statement of changes in fiduciary net position, and somewhere near the bottom, get Sherry there, perfect, there is a white line that shows 768 million. Perfect, right there, Sherry. And that represents the change, in this case an increase, in the fiduciary net position through the 3rd quarter of this fiscal year. In the same period in the prior fiscal year, it was an increase of 665 million. So this year is about 15.66% higher, or $104 million more. This higher amount of 104 million between current year and prior year is effectively net investment income being $93 million higher. Plus there was a little more in employer and member contributions by 31 million, and then those were offset by deductions being $20 million more. And the detail of that is on the contribution reports, which begin on page 17. And so I add up all of the member and employer contributions for fiscal year 26 for all 3 of these pension plans. And so they received 978.7 million in total member and employer contributions this year versus 952.10 million in the prior year. The member contributions were up 5.9 million. Employer contributions were up 14.2 million. The employer pay credit was up 5.3 million, and the AALC was up 1.2 million. General fund appropriations is the same year to year at 243.8 million between both the non-hazardous and the state police plan. And net investment income for the 3 pension plans was up $148.4 million and is 21.9 million or 17.31% higher than the prior year amount, which was 126.5 million. The 3 pension plans paid out $946 million in benefits, refunds, and admin expenses versus $928.4 million during the prior year, and that's $17.6 million more or 1.9% higher. All of that results shows that on that light yellow line, the net contribution line, that the KRS non-hazardous pension, or the KERS non-hazardous pension plan had a positive net contribution of $376.5 million, and the KERS hazardous pension plan had a positive net contribution of $21.5 million. The SPRS pension plan had a positive net contribution of $26.9 million. And this is again through the third quarter of this fiscal year. When we remove the net investment income of $109.8 million, $22.8 million, and $15.8 million respectively, the K non-hazardous plan remains positive with a cash flow of $266.7. The SPRS remains positive with a cash flow of $11.1 million, while the K hazardous plan has a negative $1.3 million cash flow. The next chart is the insurance plans, and I just start right with the yellow line there, or the pink line, the net contribution. It shows that the K non-hazardous insurance plan has a net contribution amount of negative $0.4 million. The K hazardous insurance plan has a negative $0.3 million, and the SPRS insurance plan has a negative net contribution of $6.3 million. And then when you remove the net investment income, you get that cash flow chart down at the bottom showing negative $35.6 million, $12.9 million, and $11.5 million respectively. That's the financial statements. I do have more, but I didn't know if you had questions on those through the third quarter.
Is the negative in health insurance anything related to the discussion we had with Humana?
Very little. Most of that is because this plan is close to being fully funded, and then your contributions are just really small, right? So your employer contributions that come in are pretty small.
Okay.
If you had some gain share from Humana, or if you had some of the cost increases related to the insurance plans would affect the outflows, the premium costs. So it could have a little bit of impact, but it's not affecting those big numbers down at the bottom significantly.
In this case, it's a good thing.
Yes.
Okay.
Well, in the K hazardous situation, they haven't gotten an employer contribution for several years now because they're overfunded.
Mm-hmm.
Correct.
Anything else on this topic for anybody? If not, Mike, continue.
Yeah, I believe we go. So this is the past due accounts receivable invoices at the end of March. And the total amount that was past due at March 31 was nearly 8.3 million. 3 of the top 10 past due employers, so we have the top 10 listed there, they're currently being worked by KPPA Legal, and their past due amounts total 7 million, with one being 6.7 of that 7 million. This was the numbers I'm going to give you in a minute was as of May 15, but between March 31 and May 15, most of the other top 10 employers have paid their past due invoices totaling $843,000, essentially leaving a past due amount being worked specifically by the ERSI team of $278,000. Again, there's 7 million being worked by the legal team, and then less than 300,000 being worked by ERSI. Monthly, I meet with the ERSI team and they update me on the past due amounts, what they're working on, and then the chart on the next page shows this kind of the total back to June 30, 2024. On that date, there was 439 past due invoices totaling 7.1 million. As of March 31, there's only 489 past due invoices totaling 8.3 million. But again, most of those are, and the dollar amounts related to some entities that are being worked on by legal. During the quarter, the next page shows we had 2 penalty invoices that were waived or canceled, totaling $2,000. 1 penalty invoice was created during the quarter, and 4 penalty invoices were paid, totaling $4,000 for the quarter. And then I think I have admin costs related next. Yep, so this is the budget to actual related to fiscal year 26 admin expenses and budget to actual. And there's some commentary on the next page, but basically through March 31, KPPA has spent 73.25% of this personnel category and has 26.75% left to spend. Overall, through Q3, we've spent 66.98% of our budget, or $33.5 million. The total budget amount was $50.1 million. The current spend is 1.88% higher than the same period last fiscal year, and this left KPPA with about $16.5 million to spend during the fourth quarter. Being that the fourth quarter is almost over, we anticipate being around $4 million below our budget for this fiscal year, and I think I showed that up in the fiscal year 27 projected budget amount as well. But I can answer any questions that you have on any of these big line items or individual line items that are presented below.
Mike has her hand.
Yeah, Mike, going back to the past due invoices, I know the graph shows that the amount is increasing, even though the number of entities that have past due invoices is decreasing. So with regard to the increase, substantial of that is, for example, 7 counties, and correlating that with their situation, I think we have stopped accruing benefits for them. Therefore, I wouldn't think they would have increasing past due invoices. But some of the others, I suspect, is it individualized about how you are counting past due invoices of those that are in litigation, or is it you have some general rule about that?
So 7 counties, we're no longer invoicing due to a court order. So those invoices aren't growing. And to be honest with you, the 7 counties amount that we think they owe is nowhere near what's reported currently on our invoicing sheet, because we haven't been invoicing them. The reason the dollar value keeps growing relates to Kentucky River Community Care. They have an AALC invoice that gets billed to them monthly. That's what the legal dispute's about, is the AALC amount. But we continue to bill that monthly, and it grows, and that's about $300,000 a month. So the dollar amounts grow significantly on a quarter basis specific to that entity.
Okay, so it's not okay. Well, that's helpful to know. So in this case, it's really one employer that is really materially influencing that increase.
Correct. So currently at March 31, Kentucky River, we have a $6.7 million past due balance from them, and it grows about $1 million a quarter.
Okay. Thank you.
Yep.
Anyone else? Looks like no. Mike, is that it, or you have some more?
I think that's all I have today. I could be wrong, but I think that's it.
Okay. Thank you very much. And we will move on to the investment committee report and an investment related policy review. Pruitt, Steve, and Carrie are all here for that topic.
Lane, you're muted.
I will start off by just saying we've had several meetings on the policies, and we've had several meetings of the investment committee on some call it specialty or different types of investments, and all of which have led to what I think are positive outcomes for our investments. So with that, I'll turn it over to Steve, and he can tell you whether SpaceX is going to go to $225 a share or $125 a share.
Well, if I knew that, I might not be sitting in this chair, so I probably won't prognosticate on any of that. But good morning. Thank you. Appreciate the time. Before I jump in, I wanted to turn it over to Wilshire. Wilshire's going to cover really kind of, I know the last quarter already feels like ancient history, but I believe we have Chris and Greg on, provide a very brief overview of some of the highlights, especially focused on themes that are continuing to drive the markets, and then we'll jump into performance for the quarter.
Thanks, Steve. So if we turn to slide 33, you can see here Wilshire's capital market forecasts. These are as of March 2026. Specifically, just want to call out the U.S. stock and core bonds sitting right around 5%. Core bonds actually have a slight premium over U.S. stocks. We've seen that kind of converge over the most recent couple of quarters, where we did see a negative equity risk premium of near 1%. We're starting to see those come into a little bit more parity. Generally speaking, we would expect an equity risk premium over bonds of somewhere in the neighborhood of 2 to 3%. But this is just a long-term forecast, i.e. 10 years out in the future. We can see that we are expecting core bonds and U.S. stocks to be relatively similar over that time period. Which just brings up a simple 70-30 portfolio. You can think of that as being a proxy for a institutional portfolio. That's going to be somewhere in the neighborhood of 5% over that time period. So it does really put more pressure on the alpha component of a portfolio, but also different pieces of the asset allocation process, specifically private credit, private equity, private real assets being able to be real drivers of return in the future. If we go to the next slide, you can see really one of the key issues that we've been keeping an eye on, and obviously over the weekend we got some what I'll call positive news in a deal being reached with US and Iran. How that all plays out, I think we're all interested to see. But as the title kind of alludes here, the first, second, and third most important issue is really the US and Iran conflict that has been going on and how that impacts the Strait of Hormuz. You can see that if we look back to the beginning of the year, all the container ships and the tankers that were flowing through, relatively consistency, and that all really came to a halt at the end of February. And that's really put a lot of pressure on countries to draw down on the reserves of oil. It's put an inflationary pressure on oil and other goods that pass through the Strait of Hormuz. So that's something that we will keep an eye on as we move forward through this deal, and hopefully things will start to return to normal. That's not going to return to normal by any means of a flip of the switch. It is going to take some time for this to all kind of normalize over the next probably several quarters, we would think. If we move to the next slide, and as we talked about, all of the container ships and the tankers kind of coming to a halt, what did that do to inflation? And if we look at the green and the orange lines, you can see that inflation is actually, we saw a pretty big uptick in kind of early March, if you will, as the Strait closed down. The short-term inflations reached just over 3.5%, with what I'll call kind of 2-year inflations, short plus a little bit of time, reaching about 3%. But you notice that the market wasn't pricing in a huge inflation shock once we got out to that 5 and 10-year period. So the market is looking at this as a short-term inflation shock that will have to work its way through the system. And we expect that that will take several months, if not quarters, to kind of get things back to what we would think to be more of a target inflation level. If we go to the next slide, in slide 36, one of the key themes that we were seeing at the beginning of the year was the number of cuts that the market was pricing in for the Fed as it relates to the discount rate, where we were seeing maybe 2 to 3 prices cut in the first quarter. And you can see how those lines converge up to that black line, where the market started seeing more inflationary pressures, Labor markets were starting to show signs of weakness, and that really wasn't providing a macroeconomic opportunity for the Fed to cut rates. So we've gone from moving from about 2 to 3 rate cuts to the market looking at more of a neutral position. And even as of this morning, if you were to look up the probability of rate cuts, it's probably between about a 55 and 65% chance of a rate hike by the end of the year. So we've moved into less of an easing cycle and more of a, let's see how the inflation picture plays out, potentially a little bit of a tightening picture in the future by the end of the year. And then if we go down to slide 40 here, and this is really just a zoomed in picture, if you will, of the inflation picture. You can see that nominal and real rates actually moved very, very tightly together, and that break even really kind of stayed pretty consistent through this, end of first quarter, second quarter time period. So what is the market really pricing in here? If it's not inflation, what is it? And in the longer term, I think there is still concern about the debt that is nearing 40 trillion now, just over 39 trillion, I believe it is, in the US. And those are kind of some of the longer term fears or risks that we're seeing in the marketplace. So that's something that we will continue to keep an eye on as well. With that, I will turn it back over to Steve so that he can continue to talk about the KRS portfolio.
Thank you. Page 43, please. And I appreciate not using the term transitory this time, so we're trying to remove that from our lexicon.
I cut that out from last week's meeting.
I appreciate that. Thank you. I think Pruitt's memo provided a good summary of the material that we covered in the investment committee meetings. So I just wanted to provide a few brief highlights on performance for the quarter, as well as an update on performance since the end of the quarter. From a performance perspective, the quarter really was a tale of two halves, with risk markets producing solid returns in January and February, only to give it all back in March as global markets navigated with volatility, as Chris mentioned, dominated by the conflict in Iran that oscillated almost daily or tweet by tweet between escalation and de-escalation, which whipsawed energy and risk markets. Disruptions to regional shipping is the graph that Chris showed, and really that disruption to both shipping and energy infrastructure pushed oil prices higher, and global equities reflected a broad risk-off tone, worsening sentiment while monetary policy expectations re-rated significantly in response to higher inflation expectations. As Chris mentioned, we went from potentially pricing in a cut in rates to a hike in rates, so really a 180 on rate expectations. That was coupled with artificial intelligence related disruptions really remaining top of mind, with software and memory stocks selling off and concerns growing about exposure, especially in private credit markets, with several semi-liquid private funds reported repurchase requests that exceeded their 5% NAV quarterly thresholds. Consistent with that backdrop, after posting positive performance in January and February, the portfolios declined in March, pushing the performance for the quarter modestly negative. The KRS pension composite produced a return of minus 52 basis points for the quarter, but did outperform the blended benchmark's return of minus 95 basis points, while the KRS insurance composite produced a return of minus 0.89%, outperforming the return of the benchmark by 37 basis points. At the individual portfolio level, performance for the quarter ranged from down 44 basis points to down 95 basis points, with all of the portfolios outperforming their respective benchmarks by between 31 and 55 basis points. During the quarter, the largest contributors to outperformance were the relative performance in the real return and specialty credit portfolios. Two of those portfolios that Chris mentioned are consistently producing alpha for us. The specialty credit portfolio produced a return of 42 basis points, outperforming its benchmark by 94 basis points during the quarter. And that was with 15 of the 17 underlying portfolios outperforming their respective benchmarks, led by the opportunistic credit strategy that outperformed its benchmark by 240 basis points during the quarter. Within the real return portfolio, we saw outperformance relative to the benchmark of 450 basis points during the quarter, with exceptionally strong performance in the portfolio's MLP, toll road, and infrastructure strategies, as well as the internally managed proxy portfolio. The largest driver of underperformance that offset some of that strong performance was the overweight and relative performance of the public equity portfolio, which trailed its benchmark by 27 basis points during the quarter. Fiscal year to date, the KRS pension composite has produced a return of 5.74%, outperforming the blended benchmark by 98 basis points, while the KRS insurance composite produced a return of 5.43%, outperforming its benchmark return of 4.76%. On a dollar basis, that outperformance equates to approximately $75 million of outperformance in the pension composite and $20 million of outperformance in the insurance composite. Through the first 3 quarters of the fiscal year, the real return portfolio has produced 811 basis points of outperformance, while the specialty credit portfolio has outperformed its benchmark by 217 basis points. So strong performance in both of those portfolios. That outperformance has been partially offset by 152 basis points of underperformance in the public equity portfolio. And I would note that public equity underperformance, it's not unique to the KRS portfolio. I'm sure as Wilshire would agree, active managers globally have really struggled to keep pace with the concentrated nature of the performance in the indices across kind of globally across all mandates. Turning the page, public equities reversed sharply in April, with U.S. markets up over 10%, non-U.S. markets up 9%. High yield bonds were up almost 2%, while core fixed income was flat as yields rose across the curve. We did finalize and send out April performance last week. The KRS pension composite produced a return of 4.48% for the month, while the KRS insurance composite produced a return of 4.99%. That brings fiscal year to date performance as of the end of April to 10.47% and 10.69% respectively. In May, markets remained positive, but with a slightly more cautious tone than we saw in April, as volatility remained high and very headline driven. U.S. equities were up a little over 5%, with technology stocks leading the way up over 8%. Global markets were also positive, but modestly trailed their U.S. counterparts. Of note, global rates sold off during May, with the U.S. 10-year peaking at 4.67% and the 30-year hitting a 19-year high of 5.18%, before recovering a little bit and trading back into a range. May performance is still preliminary, but portfolios are looking to return about 1.5% to 2% for the month, which would indicate fiscal year to date returns of between 12.5% and 13.5%. Brief update on June. Again, while the first quarter or the third quarter was a tale of two halves, the month of June has been a tale of two halves itself. After selling off to begin the month, risk assets have rebounded sharply, with public equities trading back to close to flat for the month as of this morning, and oil falling below $80 as optimism has grown that a durable deal will be reached in the Middle East that will reopen the Straits of Hormuz. I saw a good description in the morning. It really wasn't a definitive agreement. It was an agreement to agree to an agreement. So I think there's still a long way to go. We would anticipate volatility to remain elevated until there's a conclusion in the Middle East. Markets also, as Pruitt mentioned, saw the largest IPO in history, which priced to very strong demand, a positive sign for overall equity markets. On the macro front, despite U.S. headline CPI rising to 4.2% year over year in May, which was the highest reading since April 2023, core inflation remained relatively contained, and inflation expectations fell pretty sharply, reinforcing that thesis that this has been a supply-driven inflation shock and not something that's going to be persistent. Rates have come off their highs, but remain elevated, with markets still pricing in. I think as of this morning, Chris, I saw a 60% chance of a rate hike by the end of the year. But the case for further tightening is becoming more conditional, and markets will really be focused on central bank policies going forward, and that's globally, not just in the U.S. All eyes this week will be on incoming Fed Chair Warsh as he presides over his first FOMC meeting. It should be interesting, especially with some of his prior comments regarding guidance. So we'll see what comes of that. I'll pause there for questions, and if not, turn to page 51, please, Sherry.
Good job.
Thank you. 51, I just wanted to highlight a few non-performance related things during the quarter. We've discussed at several recent meetings Staff is continuously focused on the cost efficiency of the portfolios from an expense perspective, and we actively negotiate fee schedules with existing external managers. Broadly, we target effective fee rates that are in the lowest quartile of the manager universe. During the quarter, staff successfully renegotiated management fees with our public high yield manager, lowering fees by 12%, which results in a savings to the systems of an estimated $500,000 a year. Over the last year and a half, staff has also renegotiated management fees with 7 of our 14 public equity managers, resulting in annual fee savings of approximately $4.6 million across the systems. Also of note, the majority of assets were transferred in kind to the new Oaktree managed public leverage loan account. Given the nature of these assets, final transfers are expected to occur by the end of June or possibly by the end of July. Additionally, based on continued attractive risk-reward profile, compelling market opportunity, and current real return allocations, staff made an additional commitment of up to $100 million in the IT Rail Fund to be shared among all KERS and SPRS portfolios. And following an extensive review, staff transferred asset management responsibilities of the MSCI ACWI ex-US public equity mandate from the Franklin Equity Group to the ClearBridge team within Franklin Templeton. This change is expected to improve the quality of the overall international portfolio with improved performance, less risk, similar growth, and lower tracking error. Page 59, please, Sherry. I always like to point these out because I think it's really important. I think we focus a lot on absolute performance of the portfolios, which obviously is very important. But all of the portfolios in the pension and insurance trust produce exceptional risk-adjusted performance over the reported 1, 3, and 5-year time periods, and that's again based on Wilshire's all public plans universe, with all of the portfolios producing Sharpe ratios in the top 5% of Wilshire's peer universe over that 5-year period. And again, we really view this as an important metric, as the asset allocation guidelines that are provided by the investment committee and the board determine the specific risk parameters and constraints under which staff constructs and manages the portfolios. And these risk-adjusted return measures, I think, really demonstrate the efficiency of the performance that is produced by the portfolio. So I think that's, obviously absolute performance is very important, but I think this framing in a risk-adjusted metric is very important to determine how much performance we're getting for the risk that we're taking in the portfolios. So I'll pause there for questions or additional detail. All of the other material that was provided is in board books, or not board books anymore, but it was all the reports from the investment committee meetings. If no questions, that's all I had.
Okay, are you doing the policy review, or is
Carrie
taking? Okay.
I'm happy to take it from here.
Okay.
Sherry, if we could go to page 127 of the materials, I'd like to start there. Good morning, everyone. Thank you for taking the time to be here. I'm going to go over a high-level overview of the proposed changes to the Kentucky Retirement Systems Board investment-related policies. For those of you on the investment committee, I'm afraid this will be a little bit of a repeat, so I do apologize, but I want to at least touch on the big picture changes for the rest of the trustees. I'll take the next slide, Sherry. The bases for these recommended changes coming to you today are based on a review of other public pension plan investment-related policy. They're intended to address KPPA internal audit findings. They're based on numerous conversations with our investment team here at the KPPA, and they are based on things like the Aon study released in May of 2026 of the investment policy statements of 50 of the largest public U.S. pension plans. I'll take the next slide. From a formatting or organization standpoint, rather, I want to talk you through where we're at with our current investment-related policies for the Kentucky Retirement Systems Board, And that is a total of 10 investment-related policies. And if the board adopts the changes proposed here today, at the end result will be one sort of policy manual called the Statement of Investment Objectives and Policies, and then two other standalone policies that have some relationship to investments. I'll take the next slide. So, comparing the Kentucky Retirement System's current IPS to the Statement of Investment Objectives and Policies, which it would be, the IPS would be folded into that new manual, if you will. There's still a statement of the board's purpose and philosophy. We've added a definition section. We've updated and clarified the roles and responsibilities of the trustees, the investment committee, various actors such as the CEO and the investment team and folks at the KPPA. The asset allocation is maintained. We still have benchmarking and performance measurements. There are still guidelines and restrictions. And then we've also folded in the proxy voting policy and the investment procurement policy into the Statement of Investment Objectives and Policy manual, if you will. Of course, we've got a certification, and then we've added a revision history appendix for each individual policy or chapter, if you will. I'll take the next slide. Current KRS policies under other than the IPS, what's going to happen to those? While the security lending guidelines would be delegated to the KPPA investment staff under the proposed change to this policy manual. Likewise, the broker's policy and the manager and placement agent statement of disclosure would be delegated to KPPA investment staff under these proposed policy manual updates. The investment proxy voting policy is still going to be a standalone policy, but it will be folded into a chapter of the Statement of Investment Objectives and Policy manual. The investment transaction procedures policy delegated to investment staff. Real estate policy repealed. My understanding is that's a legacy policy that we don't really have a need for. The KRS board does not have a need for anymore. The investment procurement policy would be relocated to a chapter of the Statement of Investment Objectives and Policy manual. And then the securities litigation and securities trading policy would still remain on their own. Those are the two remaining standalone policies. I'll take the next slide. I want to highlight the big substantive changes that you would see if the board approves this Statement of Investment Objectives and Policies manual. There are lots of formatting and appearance-based changes, but I want to talk about those substantive changes. The big headline is that the investment decision-making below a certain threshold would be delegated to KPPA investment staff. Investment decision-making above that threshold would be delegated to the investment committee of the Kentucky Retirement Systems Board of Trustees, and the board itself would receive reporting on decisions made by either KPPA investment staff or its investment committee. I've listed those thresholds that kind of divide whether a decision is going to be made by the investment staff or the investment committee on this slide. You can see those. Other notable changes is adding and making some changes to the proxy voting policy. I've got Mr. Nick Zeiker from our outside counsel law firm Reinhardt here to talk a little bit about a high-level overview of those proposed changes to the proxy voting guidelines. I'll turn it over to him in just a moment. And then some procedural, step-by-step sort of nitty-gritty aspects have been removed from the investment procurement policy and will be instead housed in a procedures document that is that implements that investment procurement policy. I'll take the next slide. This slide talks about the reasons for those substantive changes, the delegation of investment decision-making to KPPA staff and the KRS Board Investment Committee. That recommendation comes from the understanding that this delegation model is an appropriate exercise of fiduciary duty, minimizes risk exposure for voluntary board members, avoids trustees having exposure to material non-public information about investments, and improves the agility of KPPA investment staff to pursue fast-moving investment opportunities for the Kentucky retirement system. And then, the changes proposed to the proxy voting guidelines are intended to address corporate governance issues. And again, I'll turn that over to Mr. Zeiker here in a moment to talk about his approach to some of the recommendations made. And the procedures have been removed from the investment procurement policy to separate policy from procedures. Take the next slide. But what's unchanged in this recommendation is that all trustees and the board remain fiduciaries. So the board is going to continue to set those asset allocations, set its performance objectives and benchmarks, assess what restrictions and guidelines it wants to maintain in order to minimize risk and ensure diversity of investment. It's going to set those proxy voting guidelines and the procurement policies, and ultimate responsibility for monitoring and oversight of the investment of assets. If the board doesn't like what it's seeing, it can change its policy at any time. I've got one more slide here that I've added since the investment committee. Since this is the board level, I do want to talk about the investment procurement policy, which will be folded in as sort of a chapter, if you will, of the statement of investment objectives and policies. That individual policy, the board can only vote to tender that today to the finance cabinet. And then there's a back and forth process that's outlined here on the screen between the Kentucky Retirement Systems Board of Trustees and the finance cabinet to ensure that the procurement policy update meets the standards for best practices in the procurement area related to investment. So with that being said, I want to pause for any questions at this point before I introduce Mr. Zeiker and ask him to provide a high-level overview of some of the, or all of the recommended changes to the board proxy voting guidelines specifically. Okay, I don't see any hands, but please correct me if I'm wrong. Sherry, I'd like to go to page 120 of the materials, please. As I previously stated, Mr. Zeiker comes to us from our outside counsel law firm Reinhardt. He has extensive experience in areas of board governance and has a lot of expertise to offer in this area. So I'll turn it over to him to speak a little bit more about the proposed changes.
Great. Thanks, Carrie. Wonderful to be here. Thank you all for having me this morning. And as Carrie said, I just thought it would be beneficial to walk through some of these proposed changes to the proxy voting guidelines that I've worked with Carrie to prepare. As an initial matter, I think it's important to note that the proxy voting guidelines are inherently tied to the board's fiduciary obligation to prudently manage its investments in the best interest of its shareholders excuse me, I have to change my wording, participants and beneficiaries. And so as a kind of an overall gloss, That's what these revisions are intended to do. And as Carrie mentioned, bringing them a bit more in line, a bit of a refreshment into to address current governance concerns. So I think if we can just turn to the next slide, I thought it would be beneficial. And as Carrie said, this may be a repeat for some of the investment committee members. Apologies. But I wanted to go through some of the particular changes here. So number one, the guidelines deal with the election of directors. So every year, the public companies are required to put their directors up for election. And as we noted at the top of this, in most instances, this is a routine voting issue. Really, these sorts of exceptions that I'll discuss in a moment come into play in limited circumstances. So in most cases, we would expect that the board would vote in favor of the management proposed slate of directors. However, a few exceptions. Number one, the board could consider withholding its vote or voting against management's recommendation if it determines that the slate of directors is insufficiently independent. So if the slate of directors is comprised of a number of insiders, really the board's function at the end of the day is to provide a check on management, a sort of an independent outside check. And to the extent that the board is comprised of overly comprised of insiders, that can undermine that intent. We've left it open for discussion and consideration based on our review of the NCPERS model. Investor groups such as CII, the Council of Institutional Investors, and other peers. Typically, we would expect either a majority or 2/3 independence. It ranges. Probably the correct answer is somewhere in the middle, but that isn't a nice round fractional number. But in any event, to the extent that the slate of directors is not sufficiently independent, that may be a situation in which the board may wish to exercise its discretion to vote against management's recommendation. The next exception that I've noted is in circumstances where the average tenure of the board does not reflect an adequate balance of short and long tenured directors. Ideally, you want to have a good mix of experience and independence on the board, or excuse me, not independence, but fresh eyes. You want to have strike the correct balance of the institutional knowledge versus an outside perspective. So in cases where the board is overweighted in one direction or the other, that is not necessarily consistent with the best practices of corporate governance. And then the final exception that I've noted here is, in the event that certain directors may not be able to devote the amount of time or energy necessary to fulfill their commitment to the board or effectively represent the shareholders, i.e. KPPA's interest, that may be another instance where the board may consider exercising discretion to vote against one or more of those directors. Really, this is intended to address situations of overboarding. I think everybody here knows being on a board takes time, and for better or worse, time is a limited resource. And when you have directors that sit on up to 5, 10, I've seen more public company boards, especially large public companies, there does become a question at some point whether they're able to effectively devote the required time to the company at hand. I'll pause for a minute if there's any questions, and if anyone does have questions, feel free to interrupt me, raise your hand, etc. I'm happy to deal with them either at the end or as we go through this here. All right, hearing none, I'll move on. So the auditor is another required item that public companies have to put up for approval for a vote every year. Again, in most cases, the selection of the auditor is usually, I would say 99% of the time, a routine procedure. There are cases, and what we've done here is really tried to build in flexibility to address these sorts of edge cases. There have been issues, particularly when it comes to certain public companies that have very, very long-standing relationships with their auditors. I'm talking about over 100 years in some cases. There could be a concern where those auditors may not be sufficiently independent to conduct their duties. Again, rare cases, but I think the flexibility is more in line with prevailing best practices. I'll move down to changes in board structure. So item 3 here. So really what we've done here is tried to sort of combine update and put into one policy language that deals with the board structure itself. So the language you'll see here reflects sort of the most recent and current best practices in terms of structuring the board. So under A, it's preferable to have an independent board chair or lead director rather than a management representative leading the board. Again, ties into the concerns I discussed earlier with respect to board independence and their role as sort of the facilitator of accountability for management. And again, tied to that, B, separating the CEO and chair roles. Number one, the CEO has a lot on his plate anyway, his or her plate anyway. The independent board director is a useful function there, but also, again, lending to independence to the board. I think so. We would expect that KPPA would generally support proposals that would form or implement standard board committees. I've listed kind of the standard three here: audit, compensation, nominating, and governance. Again, committees do the work of the board, so the board can use its time more effectively to address more high-level issues. D, declassifying the board or eliminating staggered elections. I know there was some question about this at the committee level. So a classified board is a board in which directors stand as a class for nominations. It isn't a secret board. And I will admit, confusing sometimes. But essentially what we would ideally like to see is every director stands for election every year. That's consistent with modern practices, and it's been a bit of a struggle to get there over the last 50, 60 years. But ideally now what we prefer to see is that each director stands every year for election rather than every 3 years or on a staggered rotating schedule. And then finally, implementation of majority voting. Majority voting is the preferred standard. That is where the winning candidate has to receive more than 50% of votes cast rather than the most votes. So really it's a sort of situation where you have perhaps 3 individuals running for, or standing for a position. In that sort of case, there could hypothetically or theoretically be a situation where somebody gets 1 vote and they're brought in. The majority standard is just consistent with modernized best practices. And then again, an exception here, we would expect that the KPPA would generally seek to vote against proposals that limit terms of individual directors or the board as a whole based on age. Again, I think that in some circumstances, this can come from a good place where you've got an entrenched board, you're trying to sort of refresh that board, but putting a cap on an individual director's, basically a term limit, can really encroach on that experience that is vital to balance out with the new perspective on the board. Any questions before I move on? Okay, I will continue then. 4, so I spoke about classified boards already. This is brought into the language above, so not really a change here, but more of a cleanup provision. I will then move to executive compensation. So again, this is the third of the required annual proposals that management must put on its proxy statement every year. They have to have a say on pay vote. And now this is not a binding vote. This is an advisory vote by shareholders. But generally, and this is in the added sentence that I've included at the top, when voting on say on pay or analyzing say on pay, what shareholders are generally looking for is an indication that the compensation for the executives demonstrates alignment of their pay for performance over the long term. So there's always an inherent balance between boards and management of securing long-term company performance versus short-term returns. Typically, what we want to see is at least some form of alignment for executives to be incentivized to seek that long-term performance, i.e. they're not just chasing quarter after quarter returns, which can lead to limited and short-sighted decision-making when long-term in fact, it may be better in the long term in terms of performance to take another action. So that's what the board is there for, is to ensure that. We've retained the language that we would expect the board to vote against excessive compensation plans. I think that's fairly self-explanatory. We don't want companies overpaying their executives at the expense of shareholders. But there may also be considerations, and this is in the added language, where the board may want to consider voting against compensation plans that do not contain or insufficiently address a clawback if there's an unearned executive compensation. Again, bringing it into line with current best practices. Moving on to the next page, so we've struck some legacy language here with respect to policies on employment relations, and then the next page, fair price provisions. I spoke with Carrie. My understanding is that this is language that was in the previous policy. These, frankly, they just aren't items that come up very frequently anymore, and often they're folded into, as I said, the sort of concerns that we've noted above. So striking these does not mean that this is an actual change in policy. It's just the language has been eliminated in the interest of efficiency and readability more than anything. And then finally, the last page here that I have, a few new items that we think are appropriate to address. So director compensation plans. I think generally it's agreed that director compensation proposals are good. They are a good way to kind of bring in talent. However, that is provided that they don't pay excessive amounts to directors. I think, again, self-explanatory, and generally don't consist of options, retirement plans, or performance-based awards. Again, that is intended to properly align the incentives of the board, which is really meant to serve as that long-term perspective. That language that I just mentioned is meant to insulate board members from over-reliance on short-term considerations. Number 2 here, the proxy access proposal. So again, this is, I would say probably over the last 15 years, probably one of the most sought proposals that come in, essentially permitting shareholders to allow, or boards permitting long-term investors or shareholders that own a significant portion of the company to access the proxy statement and raise concerns at the board level. So the current standard is generally a 3% ownership interest for at least 3 years, permitted to nominate up to a quarter of the board's directors. That's in line with the sort of the most up-to-date model governance best practices. Tracking stock, again, I believe that this is something that was somewhat addressed in the prior policy. Again, we don't want to have these sorts of tracking stocks because it can create the conflicts of interest between shareholders and management, directors and management. Again, if a company can make a compelling case, that it may make sense, but generally in limited situations. And then the last one here we have is intended to address more of the shareholder proposals. As you may know, this has gotten attention recently. And it is within the board's duty to consider these proposals. To the extent these proposals promote a greater transparency and oversight and let shareholders better assess the position of the company, I think that we generally support these. I know that there is Kentucky law language that does require that these have a pecuniary aspect, which I think would be intended anyway. I think that the law as it stands is intended to clarify that. But to the extent that the proposals support creation of shareholder value, better management, which then leads to better returns and better outcomes, we want the board to have the flexibility to vote in favor of those proposals or against them, in the opposite case. I think that takes me through, yes. So any questions, comments? I see Ms. Eves has her hand up. Or maybe not anymore. Yes.
Yes, I do. Yes, I do have my hand up. Sorry. Sure. Congratulations to you and especially Carrie for doing this work. It's very impressive and consolidation and helpful. These proposals for alternatives are coupled with Carrie's in the investment committee's recommendation to delegate a great deal to the staff to vote the proxies. And I get all that. But the proposals also have a lot of exceptions for if something is significantly, if it's excessive compensation, words that are not black or white at all. And my question is this: if we delegate to the staff these responsibilities to vote the proxies, and they come across these things that are qualitative, or they're not again black or white, or 5 or 10, or something that is objective, what is it that is going to guide them to come back to the trustees to vote the proxies, or to go to the investment committee to vote the proxies? Or what are they supposed to do in evaluating what's insufficient or sufficient, or whatever the adjective is that requires them to have a fair amount of discretion?
Miss Eves, I want to make a quick note of clarification. Yes, the changes that I'm bringing to you today that were approved for recommendation by the investment committee involve delegation to KPPA investment staff regarding certain investment decision making. I want to distinguish that from the proxy voting. The proxy voting is currently performed on the behalf of the Kentucky retirement system by a proxy voting service or an external investment manager in some cases. That's true now. That would be true under the proposed changes that we're bringing to the board today. And so I did want to note that distinction. But your question is still relevant, is what do our external investment managers in limited cases or our proxy voting service do if there's an area of ambiguity? And Sherry, if we could go to page, actually, let us go. Bear with me for just a moment. I want to get us to the right page. That's page 103 of the materials. And on page 103, that is the proposed updated proxy voting guidelines that are folded in as a chapter to this KRS statement of investment objectives. Okay, maybe one page up, maybe 102. There we go. And under section 2, it talks about if the policy does not provide specific guidance on a proxy issues, how the proxies are to be voted. And if there's still a question that the proxy voting service or an external investment manager has, the board has reserved its right for the KPP investment staff to direct the agent in that case on how to vote.
And what guidance then does the KPPA investment staff look to make? I mean, if it's ambiguous for a professional proxy voting who has these guidelines anyway, what?
I'll try to chime in real quick. This has only happened, I believe, twice in the last year. Both times it was in a situation where the proxy voting service could not address it because it just flat out, our policy didn't touch on the point. And it was as simple as, if you are a beneficial owner, you have to vote for, and if you're not, then you vote against, type of situation, where there was no ambiguity, to be honest, but they just didn't feel comfortable doing it because the policy didn't specifically address that particular question. That's the only time it's ever happened. I guess if it was not as clear a code or clear cut or black and white as that situation, Steve and I would have to get involved and discuss how to handle that. But we've just not faced that situation. It rarely would occur.
I would echo that as well. Again, these are ultimately what the guidelines are intended for. And again, Carrie, step in and feel free to tell me I'm completely off here. But what the guidelines are intended to do is reflect the board's general position as the fiduciary and the views that are consistent with that sort of duty of prudence and what they ultimately do at the end of the day is outline a process for consideration of these votes. And again, in those very rare edge cases, again, two over the last year, and I have to imagine thousands and thousands where that didn't come up. That is where further direction can be sought. But again, Carrie, I apologize if that's
No, that was
inconsistent.
perfectly stated.
Okay.
Thank you. Miss
Yeah.
Eves, did have we answered your questions or?
That's helpful.
All right.
That is helpful. The lack of numbers when that situation arises. I I appreciate that. It just seems like there's a lot of contention now in board voting, in shareholder voting, and it seems like to me there's a lot of increase in opportunities for when we have more words like insufficient, sufficient, excessive, that there's more opportunity there for exercising discretion. But I defer to Joe to say that if it's so rare that we don't have to concentrate on it at the moment. Thank you, though.
Missy, I also think that that's as I think Carrie pointed out in the work on this document. I think the intent is to address the majority of proxies, what the board's position is on the majority of proxies that we see. Obviously, this is a living document, so if as markets change and proxy environment changes, and we need to address that with changes to the proxy voting policy. But and to clarify what Carrie said as well, so there are external managers in a proxy voting service. They are all voting in accordance with this proxy policy. So there's not discretion there for them to make determinations that they're not comfortable with interpreting. They do come back to us with some interpretation of what the intent of the board and the proxy policy is. And some of that ambiguous language is a bit intentional in that determination can't be made kind of in the absolute at times. So what is excessive, right? There is a lot of work that is done around that by external parties that quantify some of that, and we would certainly rely on some of that work to inform our decision should we need to direct either an external manager or the proxy voting agent to make a determination on interpretation of some of this policy.
No, I would just add, as far as the external managers that do vote, it's not that they said they would. We actually have signed agreements that say they will abide by our policies and execute it. So we do have that.
Thank you all.
I think I see Mr. Chilton's hand up next.
Yes, thank you. I was interested in knowing if the KRS board has or will adopt a identical proxy voting standard so that the staff will be able to respond appropriately.
I'll just say on my end that I don't know the answer to that question at this time.
Okay. Same question on the investment policies. Are our policies similar to those or different?
I would say that there are differences that are currently in effect between the investment-related policies of the KRS board and the investment-related policies of the KRS board. Those differences include slightly different investment procurement policies, of course, different asset allocation, different approaches to the level of delegation to staff, those differences are maintained in the recommended update to the KRS investment statement of objectives and policies. But there would be further distinctions if the board votes to move towards this KRS investment statement of objectives and policies, and those differences are going to be in the area primarily of delegation to KPPA staff. There would be additional delegations in that area. There would be differences in the proxy voting guidelines. And I'd say those are probably the most material differences that would be new if the board votes to adopt this manual of sorts.
Thank you.
Mr. Piercy, if I can just quickly on that. Mr. Chilton, the statutes do allow both the CERS and the KRS boards to have separate policies for their investment policies, except in certain areas where, such as the proxy voting, there's specific language that we have to have because that's been added into the statutes. So except for those, it is not a requirement that CERS and KRS have the exact same investment policies.
Right, I understood that. I just wanted to be sure that where the differences are, and the staff's going to need to do that as well, to remember where they're different. Thank you.
I believe Ms. Eves had her hand up.
Yes. If we're on the investment.
Oh,
I'm sorry,
I
Ms.
think
Eves, you muted yourself.
Okay, can you hear me now?
Yes.
Sorry. If we're on the investment policy part of this as well, I do want to make a couple of points just very quickly. In my records, it was on page 79. The investment policy refers to the objective of our Board of Trustees is to have full funding for our plans by 2049. And I would like to suggest we add something that says full funding based on an ongoing plan. It's not a termination basis. And it seems like to me it ought to be clarified to say an ongoing plan, because we've been funding that is kind of leaves it up in the air whether that's full funding such that you would terminate the plan, which is a much higher amount than I think we're trying to have an objective of by 2049. And also carry throughout this, and again, I want to congratulate you on taking a big project with a lot of pieces and consolidating them. There's a number of references to the word insure or assure, A-S-S-U-R-E, or in. And I would suggest that we substitute that with something about evaluate, consider, or recognize that we have an objective of whatever it is. There's one place about the board will ensure that we're going to have the investment performance that we have had the goal of. And we really can ensure that, and the law doesn't require us to ensure that we'll reach the investment performance that we have set the objectives of. So I would ask you to go back and edit to take out, we just don't, again, I think we're not required to be perfect or guaranteed to not set some standard in these policies that we might not achieve, but somebody might complain that we're not reaching. Is that clear? Or?
Yes, ma'am.
It could be address or consider or evaluate or have an objective of or something, but again, ensure just, I just kind of shiver because we're not required to do that, and I don't want to be held to that perfect standard. There's a number of them, and the ones that made me shiver when it said the Board of Trustees, but there's a lot of other ensure for the investment committee too that I don't think Pruitt and the people on the investment committee want to be held to that standard or be be accused of not insuring. Thank you.
Okay, any other questions or comments? Does that do it for the presentation?
That does. And just to clarify for the board, I'm looking for a motion to repeal the 8 policies listed on pages 73 and 74 of the board materials. A vote to adopt this recommended statement of investment policies and objectives, and to adopt the changes recommended to the proxy voting guideline on the memo that begins on page 120 of the board's materials. And to do all of that and adopt with Ms. Eves' changes.
I'm not going to try to restate that, but is anybody willing to make that motion?
I'll make the motion.
I'll second.
Okay, we have a first and a second. Any discussion? Seeing none, all those in favor?
Aye.
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 Any opposed? And that motion is adopted. Thank you, Carrie.
Thank you.
And we will move on to number 10, which is the cost efficiency RFP update.
Thank you. No material prepared for this, but I think, and John, feel free to jump in as well. I think we just wanted to provide an update on where this project stands. So a little bit of background at the June 9th, 2025 CRS board meeting. The board directed KPPA Office of Investments to work with the CRS CEO to prepare and issue an RFP or an RFI or RFQ for what is titled Cost Efficiency Services. And that was directed within 30 days of that meeting. On July 9th, 2025, the RFP was issued. August 11th, the RFP closed. A number of things happened between then and really the next update with responses reviewed, interviews with the respondents, some changes made to a number of policies on the CRS side. And at the March 25th, 2026 CRS-IC committee, they voted to recommend XTP implementation services to the CRS board. At the April 15th, 2026, the CRS board approved the IC recommendation. And on the April 27th, XTP provided a draft of their service agreement. On May 5th, Vicky provided KPPA's comments to XTP, including revisions to their service agreement. We're still, I believe Vicky can respond, but I believe we're still waiting on a response from XTP regarding those comments and changes. I had a call with XTP on May 28th to clarify the scope of services that were outlined in their service agreement, as well as a discussion on terms for their remuneration. At the June 6th board meeting, CRS board meeting, they discussed whether the calculation of XTP's contingent fee would be calculated based on CRS's savings or the total enterprise savings, which would include KERS and SPRS. And my understanding is that's an ongoing discussion within the board. So that's an update. We're working on CRS's behalf to negotiate and execute a contract with XTP for broadly what was outlined in the original RFP, which are cost efficiency services that fall into a couple of categories, some benchmarking, some cost benchmarking, some fee validation, review of existing contracts and terms are the main tenets of those scopes of services. So John, happy to, if you want to add any color to that, or happy to answer any questions.
Yes, thank you. After discussion with several trustees, not in quorum, but just in conversation, I may be in a situation where I could recommend a contract for KRS with XTP, but we haven't really determined what the terms of that contract would be, but we're going to move in that direction. Nothing's been approved by the board, of course, as of yet.
And we would be happy to set up a presentation from XTP so they can walk everyone through their services and what they provide, and kind of outlined in the original RFP for cost efficiency services, if that would be something the board would be interested in.
Right.
Steve, I think I'd be interested in having you do that presentation. You've gone through it a couple of times, and you can give their side and anything else that might be of interest to the trustees.
Sure, I'm happy to do that as well.
Steve, correct me if I'm wrong, but the C Investment Committee, I guess, heard the presentation, but and you reviewed all the responses that came in, but you did not recommend XTP to that board. Is that correct?
They specifically did not request a recommendation. What they requested was a screening, essentially, of the responses and our diligence on those service providers, and then a list of firms that we felt met the qualifications, and they independently picked XTP Implementation Services as the provider. Yes.
And I'd also like to add, and again, correct me, but it's been your feeling that internally the moves that we've made and the analysis, and I'll just use an example of Anthony's discovery of Bay Hill without any outside help, we were getting shafted there. Joe has saved us $3 or $4 million on the process of renegotiating fees, and so there seems to be a feeling that. And the last piece is that we've been using CEM for 5 or 6 years now. Is that correct, Steve?
Yes.
And they consider our fee structure and have pointed out that it is in almost without exception, we're in the bottom quartile of fee cost. In other words, better than 75% of the public funds out there. So that it has been my feeling that it's hiring an outside consultant who's frankly not the best in the business. That's my professional opinion, not a fact, but a professional opinion, that it was unnecessary. So I think we have to tread lightly on how we work with incorporating their output.
Well, I do. I think we went through a recent audit. It seems recent. It was a little while ago that reviewed our process. And again, the specific scopes of services that were looked at, you're right. There was some benchmarking work in that original cost efficiency. There was some contract term validation, and benchmarking from a cost perspective, obviously not a performance perspective, but from a cost perspective. And then what we've broadly considered validation, right? So fee and expense validation, so that they were, all the fees that we paid are in accordance with the terms of the contract, calculated correctly. You bring up a great example of one historically where staff was able to uncover that fees were not being calculated correctly, and certainly not in KPPA or KRS's or SBRS's favor, which is often the case. So, historically, we have looked prior to this engagement at fee validation. That's something that some trustees in the past were interested in, and whether there's a number of firms, as you mentioned, that do external fee validation. So there is some independence as to those calculations and assurance to trustees that we're paying in accordance with the terms of the contract. Staff, I think I think that we would never be opposed to that. That I think is a worthwhile exercise, something that we've looked at. I think both internally, staff as well as internal audits has done a good job of reviewing our process. We feel good about the level of fees based both on that CEM benchmarking as well as our own market intelligence and discussions, negotiations with external managers. Again, as you pointed out, Joe has done a fabulous job with the public equity managers, and we feel we're paying low fees from a relative basis, which is really important. Fees matter. Brian recently negotiated lower fees for one of our public high yield managers. So, and Anthony does a great job with every new manager in the private space. We work hard on getting low fees. So I think we feel good there, but whatever the board feels is appropriate, we're obviously happy to have discussions with external providers or to negotiate on your behalf for any services that the board and trustees feel is warranted.
Yeah, I would say I just came back from the ILPA conference for members, which was just our peers, and there were no managers, but there were vendors, and one of them was acquired by Hamilton Lane and folded into there. And talking to them, the fee verification business is not a standalone thing. They just have not, I think, historically found enough to make that a thing. So I think that they obviously are trying to package that into a larger private markets consulting thing, but or perhaps different systems, their database and stuff like that, like we use with Alborn. But that was just another just a data point that I got from there, is that that's a group that did talk to us about that in previous years, but it's one no longer independent, and two doesn't they just didn't find that to be something that really moved the needle for them. So.
Ms. Eves, did you have a question?
Yes. Steve, did this RFP or have to go through either the Kentucky procurement procedures or not? And if it did, has it already been through them? I mean, one thing you have to do is demonstrate the need for this and the superior vendor.
So that's a little bit of a complicated question, and obviously given the timing, the original RFP was at least contemplated to be a KPPA RFP. John and I talked several times on the scopes of service, and we talked about that. There was I guess kind of a pivot midway through after the responses were received as to what the procedures would be followed in order to select the vendor. And we did follow the CERS investment procurement policy as it now stands in the selection of the vendor. So that procurement policy was followed, and that's the determination was made to engage with XTP and negotiate a contract on behalf of CERS. So I'm not sure if that answers your question, Ms. Eves, but that's...
I can add a little color, Steve. So under both the statutes for KRS and CERS, investment-related services, not just the hiring of managers, fall outside of 45A, which is what you were referring to, Ms. Eves, as long as they are procured following the CERS or KRS procurement policies. Both of those policies have to, once the board, just like the one that you just approved now, Carrie is going to have to send that to the finance cabinet. So it's not final because the board just approved it. It has to go through the finance cabinet for them to look at the KRS investment procurement policy, and the CERS investment procurement policy went through that process. And then the finance cabinet releases comments, requests changes, and then is supposed to then say a letter that it is actually following best practices. So it did not have to follow the 45A process. It followed the CERS procurement policy, as Steve indicated, because CERS was the one right now that wanted to move forward with the fee validation and the auditing of the contracts. This has not come before the KRS board yet for them to determine anything, so it is moving forward with CERS only.
Steve, question?
Thank you.
Steve, I've got a question, or more of a comment.
Sure.
Yes, is that okay?
Sure.
And I'm going to say this, not endorsing CER's position nor the choosing of XTP. But I've watched all the CERS board meetings, investment committee meetings. It seems to me one of the big questions that are coming up is because our assets of all the pension insurance plans, in many cases, most cases, I'm going to say all, but many or most, are basically for all 5 pensions, all 5 insurance plans. If XTP or somebody came back with a recommendation for a change that would benefit the overall investment plan, how would that end up getting divided? And I want to, I guess what I'm, it almost seems like we've got to go along with this in some manner, because if the recommendation was made that was going to save KRS X number of dollars, and we did not take advantage of that, for whatever reason, it would seem like that would put us in a bad situation. And admittedly, I may not know enough about the specifics of the contract and what may come out of it, but I don't want us to get into a situation where we again don't take advantage of something that's offered to us that could be beneficial for our plans. Did that come across clearly enough?
Oh, absolutely. It's the question's clear. The answer may not be as clear, and it's very dependent upon what exactly was found, whether that is a couple of examples, easy examples. So if there was an overpayment of $100 in expenses to a private equity fund that we're going to recoup, the systems are going to recoup, so the manager is going to pay back, and this is pay back $100 to the systems. That $100 would come back to the systems based on the ownership of that fund. So if CRS owned 70% of the fund and SPRS and KERS owned 30% of the fund, they would get $30 back, and CRS would get $70 back. So they would participate in the money coming back. Now, how, as I mentioned, the discussion is what's the base to use. So XTP's contingent fee basis is for recoveries is they get 50% of the recovery. So they either are due $50 on the enterprise or $35 if it's considering only CRS's assets. And so that's an ongoing discussion within this. My understanding of the CRS trustees are still having that. So if there's recovery because of how the unitized ownership and how the assets are owned, K would get their share of that recovery based on the ownership of the underlying investment where the recovery was identified. If it's a negotiated fee schedule, and for instance, if we're paying 20 basis points for management of a certain fund, and they're able to identify that you should only really be paying 10 as the market standard for your size and strategy, and we're able to renegotiate a fee schedule lowering the fees from 20 basis points to 10 ongoing, because of the unitized nature of the investments, the K would have the same fee rate that is going to be negotiated on behalf of CRS according to the XTP contract. And again, their contingent fee basis is 2 years. They get 50% of the fee savings for 2 years for that type of cost savings.
Okay, so
I'm not sure if that answers the question, but that's.
Yeah, I remember that almost verbatim from the other day. But so the question comes down to who pays XTP's bill, right?
Correct. Both the base, how it's calculated, and who pays it. And currently, and Vicki, you can correct me if I'm wrong. Currently, we are moving forward with negotiating the contract on the behalf of CRS. So CRS would be the one that enters into the contract with XTP. What they end up, the fee will be 50% of the savings, either for recovery or 50% of savings for 2 years. That's currently the terms of the contract. How that's calculated, I think, is still to be determined. And in the $100 example, is it calculated based on $70 in savings or $100 in savings?
Yeah, I just don't want to see a position where it looks like we're not accepting a savings to the plans.
Larry, I'm going to speak on this right now. There is no contract right now.
Right.
There was an agreement that KRS is going to retain XTP implementation services. There were two portions that the board approved in public session. One of them was to do an audit of our current contracts to see whether or not we have been charged the correct fees. The second part is then authorizing XTP to renegotiate the contracts if they've determined that the current terms are not market. Questions have come up, as you heard if you watched the KRS meeting, that because KRS is the only entity that has approved this, when I did my initial response to them, I limited it because right now KRS is my client. I limited it to KRS's investments. And there's 3 retirement plans and 1 insurance trust plan. So I limited it to the KRS investments in the overall investment pool. There are some KRS only investments that KRS has titled in its own name, but because the investment or the split happened in 2021, the vast majority of contracts are still under KRS's name because KRS is and has always been an administrator, not a retirement system. It used to administer 3 retirement systems, now it administers 2, and then there's the insurance trust plan. So right now, as it stands, we're waiting for comments back from XTP, but the changes were to limit it to KRS's recovery. So when you talk, Mr. Totten, about not getting our recovery, KRS, this has not come before the KRS board to determine whether or not they wish to engage XTP services to do an audit. It's still going to be the same audit because it's the one contract right now under KRS's name. But then does KRS want XTP to negotiate contracts going forward? Do they want that to come back to the staff? Do they want that to come back to investment counsel? That is, still out there. So there is no current contract. There is back and forth, obviously negotiations happen once they have determined which one they are going to hire. The overall discussion that was at KRS was, well, if XTP is doing the work and there's a KRS, say, recovery portion, or should they negotiate for KRS going forward, but KRS is not a signatory to that contract. And so at the end of that meeting, Mr. Cheatham said, well, there is no contract and we are waiting for XTP's responses to my KPPA's initial rounds to XTP. I've not been involved in any conversations. I mean, you heard Steve say XTP contacted him, and I believe XTP has contacted Mr. Owens. But for black line or red line coming back to me from my red line, that has not happened yet.
Okay. Like I said, the whole question was, I just don't want us to look like we're not accepting a benefit.
I will have to say from my side, for ease of service, the faster this comes before KRS's board so that there's not 2 separate contracts, if there can be 1 contract, that would be great. If there has to be, if KRS's contract is signed next week, XTP is going to start its work. And then when it comes before KRS, then KRS can direct me to enter into a separate contract with XTP.
Sounds like a plan.
Mr. Lane, I just wanted to let you know that Mr. Piercy had to drop off the meeting. So as vice chair, he wanted me to let you know if to see if you would follow up with proceeding with the meeting.
Well, I'll just call for adjournment. No, I won't. I will know. Thank you I will take over at this point. I think we've gotten a lot out on the table on the RFP situation with XTP, and I think Vicki has laid out what should be a good game plan, and hopefully we can execute along that line. John, you're still up as a CEO report.
Right. Thank you, Mr. Chair. Wanted to report things that have happened in the last 90 days since our regular quarterly board meeting. And that is that I've participated in numerous conversations and reviewed documents in connection with ongoing litigation. I've talked with various board members and attended the committee meetings and the PPW meetings that occurred during the last quarter. I met with the new trustees early in this quarter and have continued to attend PPOB, Public Pension Oversight Board meetings. And I've been involved in the XTP discussions and went through the 30 pages or so and delivered comments to Carrie on the investment policy statements that have come forward. So it's been a fairly busy quarter from my perspective. That's it.
Any questions for John or thoughts? Hearing none, we'll move on to Ryan with the KPP update.
Yes, thank you very much. Self-aware enough to know that we're about 2 hours in, so I'm going to do this pretty brief. Please stop me if you have questions. We had a director's meeting recently, and I thanked them for the participation in some various programs. 3 of these are kind of at the state level, the intern program. Yes, there is an investment intern among the 6, so we take advantage of that at the state level. Then internally, we have the management essentials. And then we have 2 people in both the governor's leadership program for emerging leaders and the executive leaders program. So happy to have representation from KPPA at all of those. If we could advance the next page, Sherry. The strategic plan, please look forward to the update on the 25th. We'll go into detail on that. I'm definitely looking forward to it. Aaron will present that. Like everyone to tentatively hold both October 22nd and 23rd for the second impact. We still have some paperwork to do, so it's tentative at this point, but please block out your calendars. As John mentioned, PPOB met, and then Aaron and I did the same presentation to the budget subcommittee on retired reemployed. I think that went very well, and we would expect some discussion in next session on that. Briefly on the Louisville office, I think it's good news now. We do have a tentative date for occupancy this fall, and we're actually ahead of schedule for once on that project. So I appreciate Finance Facilities and their work towards that. Sherry, there's a number of kudos. If we could go to the 4th from the bottom. Yes. So wanted to recognize I got a call recently talking about not only just the meeting related to retirement, but just the whole process from entering the door to the greeting to getting back there. And I thought that was noteworthy. Number of mentions today about Joe and the work he had done, and that there's some of the savings is listed there. Mr. Riley had a pleasant experience that I wanted to give a kudos for as well. And then Jack Mindler and team. So happy to take any questions, but I just wanted to go brief and be respectful of your time.
Thank you, Ryan. Appreciate that and the good information. Let's see. Let me get back to I had the KPP update. I'm not aware of any new business as vice chairman. And I believe we do not have Vicki, is this correct? We do not have a closed session planned or needed?
That's right. That's right. Nathan was going to go into closed session if he had any questions on the report that Michael had in there, but Mr. Piercy indicated that there was no need.
All right. With that said, I can then move to the always popular move to adjourn. I will make a move to adjourn unless there is objection. And hearing none, we are adjourned.
Thanks, everybody.
Thank you.